The upper boundary of a failed ascending triangle can still be used to reference support, like a successful ascending triangle, when there are bearish retracements at new highs in 2007. Except the support range can be widened just under 2770, especially with the first upswing. This is due to the ascending triangle falling from what would later become a gap fill range. August demonstrates a case where sustained selling leads to the break of a solid gap fill support, that is the 2910 level in this case. Here is a great example where price can return back within a gap range, but not necessarily lead to an instant fill, even when there is a small but stable downward channel. This can in part be attributed to lower volume and activity leading up to and around the late November and December holiday periods of lower activity. Though this can happen at other times of the year with normal levels of volume, it is less common. Similar to August 2007, here is another case where even strong gap-up fill support can eventually be breached. When there is sustained selling pressure, a large downtrend progresses a less strict double top's bearish influence. As usual, old levels provide excellent references for resistance areas during a later recovery that sees the old downtrend line retain residual bearish influence to slow the rise from September to October. The old 28 to 27 range becomes a first crucial long-term support as 2010 begins with a declined double top reversal. The chart is neutral to bearish in the long term as the October gap up is not immediately filled, but trading is still confined within a wider horizontal range with persisting selling pressure. After the 2660 gap fill level only slowed down the strong drop, it presented normal resistance to the bullish retracement. The 24 to 23 range naturally becomes the next major long-term threshold to watch. The range under 2660 can be considered a failed double bottom. That becomes the horizontal resting phase range in a regular bearish continuation, with large-scale 3 methods falling price action. This is the main reason why bearish strength increases approaching July, for a brief break under the solid support offered by the 24 to 23 range. The general downtrend can now more clearly be seen to be originating from a less strict triple top. The old 24 to 23 range does indeed turn out to be major long-term support. In June 2011, there is a much more stable bullish reversal from a compact double bottom and a reverse head and shoulders formation that has more stable price action. This is in contrast to 1 year earlier when the first initial drops were accelerated by bearish continuations. The 23 to 24 range was still firm support back then, but was less precise as short-term bearish overextensions drove price well under 2390 during brief volatility. August sees another double bottom reversal. While there is bearish and volatile price action, it steadily decreases. This leads to stable price action forming the second upswing and completing the pattern to avoid a breach that would lead to bearish overextension like in July 2010. As the decade moves along, a stable recovery takes hold after the pair of double bottoms stabilized the 23 to 24 range. Microsoft continued to fall into periodic range-bound trading during a larger uptrend that saw many of the old ranges quite accurately marking the site of various ranges and even a few gap ranges. Here is a great example where a descending triangle develops a wider gap down fill range. That is the 4550 to 47 range on this chart. The expected strong gap fill resistance is bypassed by a gap up that now becomes a crucial support. Interestingly, the late April gap up essentially reuses the exact same ranges from the January gap down, which is not that common as seen with other examples. Gap ranges are essentially close to the same significance as ranges formed by patterns comprising swing points. So it is not too surprising the 47 to 45 range is a contentious area and the site of role reversal. Unless there is a rapid bullish spike, the noticeable decline over the last few weeks can begin to fill in the gap and complete a delayed declined double top, with a widened lower boundary due to the 47 to 45 gap up range. July began with the gap technically getting filled, as price just dipped under the 43.45 level, crossing the upper wick of the gap fill candle. Later, there is another case where persisting selling pressure breaches the gap fill support and enters the wider triple bottom range, where support potential progressively increases closer to the 40 boundary. As Microsoft breaks out of the long-term range, mainly defined by the gaps, a double top and gap fill are avoided, with the emergence of a distinct incline displaying and avoiding contact with the key 52.25 level. Microsoft falls into its characteristic behavior of wide horizontal ranges that are eventually surpassed by generally stable inclines. Usually these features run through at least some swing points related to gap ranges. Adjusting the uptrend line is helpful as the 224 to 231 range is cleared and likely to become the next major lower boundary as Microsoft reaches new highs. Incidentally, the 231 to 224 range outlines a compact double top reversal that was more difficult to spot due to its small size. Although Microsoft had an overall decade-long bullish run, it is important to remember nothing, including large uptrends, lasts forever. This is neatly summarized by the old ranges from the previous decade that saw a long period of range-bound trading, after a major drop during the famous tech bubble in the year 2000 crash. It is also worth noting, on the other hand, long-term highs can eventually subside in selling pressure and can be surpassed by steady uptrends, like with the rise over the old 59.97 peak.